If you're tired of paying your landlord's mortgage and want to achieve the goal of home ownership, you've come to the right place. Hi, my name is John Charbonneau. I'm an accredited mortgage professional with TMG, the Mortgage Group, and I will be your host for our first-time homebuyer webinar. For many Canadians, home ownership is considered a sound investment, and for the majority, it represents the pinnacle of personal and financial success. Purchasing a home can also seem daunting and overwhelming. It's probably the biggest emotional and financial investment decision you will ever make. Before you start looking at homes, you'll want to do a bit of homework. Our webinar will provide the early insights you need to have a successful and enjoyable first-time home buying experience. As promised, we will have 4 presenters. A realtor who specializes in working with first-time home buyers, a home inspector, a lawyer, and myself talking about mortgages and getting pre-approved. On this page, you will see a comment and question box. We encourage you to send us your questions. There's a good chance we will cover your questions in the material we have prepared. If we don't have time to get to your questions during the webinar, don't worry, we will get back to you by email with an answer. Our first presenter is Michael Cosburn. Michael is a full-time licensed realtor with Home Life Benchmark Realty, and he is also the corporate trainer for 5 offices in Langley, White Rock, Surrey, and Cloverdale. Michael has been serving buyers and sellers for the past 8 years. So, let's get started and welcome Michael Cosburn.
Thanks very much, John. I'm excited to talk to you today about the buying process. But first, let me give you a little bit more information about myself. I graduated from UBC with a BA in philosophy, where my focus was on ethics. I went on to teach business English, and I'm currently working out of the Home Life Langley office. Along with my regular duties, I'm also the corporate trainer. I love the real estate profession because I get to help people achieve their home ownership goals. And also, I get to teach the new realtors coming in on how to be professionals. So where does one start when buying a home? Well, once you decide to start looking for your first home, it can be somewhat overwhelming, but it doesn't have to be. I'm going to break up the process into a step-by-step program with my Buy Right system, so you can make the right choices for your purchase and your future. So let's start with the PowerPoint presentation, shall we? So here's the Buy Right home buying system. And the whole purpose of this is to make your home buying journey enjoyable and worry-free. So, Buy Right. We're going to begin as CEO of buying your home. What does that mean? Well, you need to assemble your team. First of all, you need a realtor, and then you need a mortgage broker, like John. You're going to need a home inspector and a lawyer. And they're going to we're going to walk you through the steps. You're going to need to understand your financing. So you're going to want to talk to John. You're going to want to get pre-approved first, so you know how much you can afford before we even start looking at a single place. Obviously, you want to know what your monthly payments are going to be, because monthly payments are important, and you want to have enough money left over each month to live your life. So you select a realtor who will represent your best interests and has a strong negotiating skills. They can demonstrate their market knowledge and expertise to you, and they're going to treat your money like it's their own. You want them to make you feel like you're their only client. Of course, most of us have other clients, but we want to make you feel like you're our only client. So what does that mean? That's putting you first. Now that you've decided on your realtor, you're ready to move forward. The right way. Looking at homes the right way is important. So we're going to create a list of must-have features. For example, your specific price range, which is very important, particular neighborhoods, and the number of bedrooms or maybe the lot size of what you're looking at. This is all important. So we're only going to put deal breakers on this list. Items that if the house does not have it, you do not want to see those homes, no matter how nice it is. So for example, if you're looking for a 4-bedroom home with 2 bathrooms and there's a 3-bedroom with 1 bathroom, we're not going to look at that. So once we have our list, we're going to start looking right away. We're going to use your list of must-haves. Again, some other examples: a south-facing backyard, a den, or maybe you need an office, or you want to have an open kitchen or an open concept, a double garage, right? Your dream home will have all the must-haves, or as many as would be possible. Sometimes it's not always possible, depending again on our price range and the neighborhood in which we're looking, right? Some areas have older homes, and maybe those rooms aren't going to be as big, or maybe they don't have enough closet space. But if it suits the neighborhood that you want on your list, then we'll look at those. Information is needed to look at these homes, and a lot of information is needed before you even decide to look at those homes. So you need to hear about the new listings immediately, as soon as possible if you can, as soon as they hit the market. And you can't get this information by yourself. So if you have a look at this information timeline of a listed property, if we look at day 1, the realtor lists the home, signs the contract. Day 2, the listing is sent to the real estate board. And day 3, the listing hits the realtor's MLS, which is realtor.ca. So there's a bit of a 3-day delay here sometimes. Sometimes it might be a little bit faster, maybe 2 days if the realtor uploads the information directly to the real estate board, in which case we might gain a day. But then we have when the listing hits the public MLS system, day 6, again, might be a day earlier, but we're still lagging behind in terms of information. So if you're looking at newsprint, for example, the first ad in the Real Estate Weekly, day 6. And then maybe the open house day 7, but it could be a little bit earlier, day 6, something like that. But if you're looking for this information in the newsprint when it's out on day 6, this home may be sold already, depending on how quick the market is. And sometimes the market's very fast. So that's why it's important to have your team assembled and have your pre-approval ready to go, so we know how much money we can afford, and then we can move quickly if we need to. Identify the comparables for the right price. You will know the one that you want to write an offer when you see it. And we're going to look at as many homes as it takes to find the one that you're looking for. But we want to look at the sales prices of comparable properties when we do decide that this is the right home to make an offer on. And what are comparables? Well, the similar type of homes or condos that we've seen in the same area that have been sold, or on the market for an extended period of time. And then we can average out the prices. And I will present you with a comparative market analysis for that so that you can see the comparables that are in this neighborhood. Then we go for it. We make the offer and we get it accepted. And we got to pay attention to the dates and the details of the transaction, and your qualified realtor will assist you with all of this. So for example, if you're currently renting and you're going to make the move, we need to make sure that the dates kind of line up for you so that you're not paying too much money on the rent side and we can overlap with your mortgage. So just to make sure all those dates come into effect. You may have to negotiate a little bit, which means a little give and take, right? We have to be reasonable with the dates, and sometimes the seller may want a longer period of time to close the deal than you're willing to, accept for the time being. But if that's the difference, the only thing, then we need to be reasonable and kind of negotiate that for both sides. If it's taking longer and it's costing you more money on your end, then we can negotiate for a better price from the seller and explain that, the client has to pay more money if we wait too long. People are generally reasonable and they're going to accept that. Handle the details. Well, we have the contract and the addendums, a title search, inspection day and the reports, strata documents possibly if we're dealing with a strata property like a townhouse or a condo, and then the mortgage documents and appraisals. There's a lot going on here, but we will guide you through with the contract and explain, and we will try and match up everything that you need in terms of your price and your dates The title search, we kind of want to check to make sure who's on title, who's actually selling this property. And if it's a home, we want to make sure there's nothing on the title that may prevent us from perhaps building something on the land itself, like a statutory right-of-way or an easement. And I can explain these things as we go along together. Inspection day. Well, once we're kind of approved and John's given the okay with the financing, we're gonna go with the inspection later in the subject phase. And the subject phase is usually that 5 to 7 days, where we're kind of getting all the details together after we have the accepted offer with the seller. So the inspection we kind of want to put at the end to make sure everything's okay to move forward, because the inspection usually costs between $400 and $500. So we don't want to waste money frivolously if we do the inspection on day one and we find something, say in the Strata documents, that doesn't make sense that we don't want to purchase. We don't want to waste your money. Once everything's approved, we've got the inspection and it looks good and the Strata documents look good or the title looks good. John says we're good to go with the financing. That's the day we remove subjects at the end of the subject phase, usually 5 to 7 days. Once we remove the subjects, we have the deposit draft ready, and that's when the deal becomes firm sold, which means it's sold and it's basically yours until completion day. Now, it's time to move. We've done all we needed to do. Now we just need to do is just make sure that the home will be ready for moving day. Talk to me about this. I will be in touch with the other realtor to make sure that the sellers are on schedule and on time. And sometimes people are not on schedule or on time, especially with moving. Moving can be stressful for a lot of people. And imagine if you had a 3,000 square foot home with a shop. These people tend to accumulate a lot of possessions, and you will see once you're packing your own how much things we actually accumulate. So I will make sure that they're on schedule and you will be ready to move on that day. But we want to make sure that if you're lining up a moving truck and we're, say, taking possession at 1 p.m. on Saturday, we don't want the truck to be there right at 1 p.m. Let's give the seller some time to vacate the premises, and that way you're not paying extra time for the movers to be there right at that time doing nothing, right? If, however, the property is vacant, then possession at 1 o'clock is an easy possession. When asked by your friends and family about your moving experience, I'm looking for you to reply with Michael Cosmer's Buy Right system was fantastic. It's enjoyable and worry-free. Call him for more information. So, as you can see, there are a few steps involved when you're going to purchase a home. But if we take care of the details, we can be ready to move forward quickly if need be. And remember, it costs you nothing to work with a realtor when you're buying a home, because the commissions are paid by the seller. If you already know which area you want to move to but aren't ready just yet, ask me to set you up on my free market snapshot so you can keep an eye on the prices and the new listings that come up in that area. Contact me with any questions you might have. My phone number and email address should be there on the screen, and I look forward to speaking with you. Thanks for joining me on this segment. Now back to you, John.
At this point, I get to switch hats from being your host to that of being your mortgage broker. For many first-time homebuyers, the role of a mortgage broker might be an unfamiliar one. So let's take a moment and review what my role in the home buying process is. In short, I'm the money guy. You meet with me, we look at what your home buying goals are, and I make the arrangements to have your financing approved. I deal with banks, trust companies, credit unions, life insurance companies, and pension funds, all of which provide various types of financing. My job is to find the best mortgage for your needs, get a highly competitive rate, and show you which lender has the best product for you by showing you how their offerings compare with regards to penalties, prepayment options, and how the fine print from one lender can make a huge difference in the long-term cost of owning a home. One of the best parts of dealing with me is that my fee is paid by the lender, so working with me does not end up with you paying me a fee. In short, I get paid by the lenders to offer you their best terms. With that out of the way, let's get started with the financing process of buying your first home. Let's talk about your first challenge, saving for a down payment. Once you decide that home ownership is in your future plans, you'll want to set up a budget so that you can begin to save money for a down payment and to cover closing costs. A down payment is the portion of money that you will contribute towards the purchase price of your home. Saving for a down payment is a crucial step towards home ownership, and it will help you prepare for the financial obligations that are associated with it. The more you contribute to the purchase price, the lower the amount of mortgage financing you will require, and with a lower mortgage comes a reduction in interest paid to your lender. There are two primary types of down payment: money you have or will save, and money that is gifted to you by a family member. First-time home buyers should try to set a goal of saving between 5% and 20% of the purchase price. There are a number of government incentives. Let's talk about a current government incentive for first-time home buyers with respect to down payment. It's called the Home Buyers Plan and provides assistance for potential buyers to realize their dream of home ownership. It allows you to use your RSP for part or all of your down payment and to assist in covering closing costs. Qualified applicants can withdraw up to $25,000. Applicants have 15 years to repay the funds back into their RRSP. Applicants must be residents of Canada. Applicants must have an agreement to purchase at the time of the withdrawal. Money withdrawn from an RRSP under this plan must be on deposit for 90 days prior to the withdrawal. At any time, an applicant can repay any outstanding balance without penalty, and the funds must be used to purchase a primary residence for the applicant. The amount of your down payment determines the loan-to-value ratio. The loan-to-value is the amount of the mortgage loan compared to the value of the property. Typically, lenders will limit the loan to an amount less than 95% of the value of the property. Loan-to-value ratios are used by lenders to determine whether or not you will qualify for the loan, and if the loan will be classified as conventional or high ratio. Conventional mortgages have a loan-to-value ratio of 80% or less of the purchase price, and high ratio mortgages have a loan-to-value greater than 80% of the purchase price. If you are borrowing more than 80% of the purchase price, you will have a high ratio mortgage, and it must be insured so that the lender is protected in case you do not make your mortgage payments. Currently, there are 3 high-ratio mortgage insurance companies available in Canada: Canada Mortgage and Housing Corporation, CMHC, Genworth Financial, and Canada Guarantee. High-ratio insurance is often referred to as mortgage insurance or mortgage default insurance, and should not be confused with home insurance, which you can obtain on your own to cover the cost of the loss of your property or contents due to things like theft or fire. The mortgage insurance premium can be paid in a single lump sum when you close your mortgage, or it can be added to the principal balance and paid off as part of your mortgage. The insurance premiums are identical from one insurance provider to another. Each of the 3 insurers provides different policies and guidelines. A mortgage application declined by one insurer may be approved by another insurance provider. Not all lenders deal with all 3 insurance providers, and this can result in one lender turning down an application, but the same application presented to another lender could result in an approval. In addition to putting together a saving strategy, it is important that you establish and maintain a healthy consumer credit history. Your credit report will show the lender how you handle debt by providing information on how much credit you have and if you are able to make your payments on time. Your credit report is created when you first apply for credit or borrow, and it is tracked over time. The information is collected and maintained by credit reporting agencies, also known as credit bureaus. In Canada, there are two major credit bureaus, Equifax Canada and TransUnion Canada. A credit bureau may provide credit information via a report referred to as a credit report and will provide a lender with a three-digit number as an overall evaluation of your report and is called a credit score. Since your credit report provides an overall picture of your financial history, lenders and credit grantors will request a copy when determining whether to lend you money or grant you credit. Any negative information may adversely affect your ability to borrow money or obtain credit, so it is important to maintain a healthy credit history. Making your payments on time for all loans and credit you owe will contribute to your credit worthiness and present you as an attractive borrower to lenders. Generally, the higher the credit score, the lower the probability a borrower will be delinquent on payments of credit granted. The credit score is based on a statistical formula combining personal information from the credit report and other sources to arrive at a score ranging from 300 to 900. For those borrowers with less than a 20% down payment, the credit requirements have increased over the past couple of years due to the Federal Minister of Finance in Ottawa implementing policies to reduce the number of riskier loans offered by lenders in Canada. Loans that were commonly approved only a few short years ago are now being declined as a result of borrowers not having high enough credit scores. It is worth noting that it is a wise idea to review your credit to make sure the information is correct and to take the time to correct any errors that negatively affect your overall score. You are entitled to receive a free copy of your report by mail from each of the two major agencies. Reviewing your credit is something best done in the early stages of the home buying process so that you have time to make changes either by correcting mistakes or improving payment history and your overall score. How much home can you comfortably afford? Before you head out with your real estate agent to look at homes, you need to determine how much home you can comfortably afford in total monthly housing costs. Your affordability depends on your income, your down payment amount, mortgage interest rates, and any other financial obligations you may have. The amount you can afford as a mortgage, plus the money you have saved for your down payment, will determine the price of property you can afford and will help you and your real estate agent focus on homes in your price range. To determine how much mortgage you qualify for, lenders will use two simple qualification ratios: the gross debt service ratio, GDS, and the total debt service ratio, TDS. Let's look at these ratios in greater detail. Gross debt service ratio includes the principal and interest component of your mortgage payment, property taxes, an allowance for heating, and 50% of the maintenance fees for condos. Provided all other conditions are met, lenders can allow a borrower to use up to 39% of their gross income to service the debt of a mortgage payment, property taxes, heating, and 50% of the monthly condo fees where applicable. In addition to the GDS ratio, a lender must consider any other monthly debt obligations for repayment of such items as credit cards, car loans, and student loans. When the repayment amounts are added to items included in the GDS, the total debt service ratio should not exceed 44% of the applicant's gross income. The ratio of 39% GDS and 44% TDS are considered the maximum allowable ratios acceptable to the high ratio insurance providers. This does not mean that every lender would approve a borrower to take on the maximum mortgage under these guidelines. To be approved for the maximum mortgage, a borrower would need to meet additional criteria such as income stability and credit history. The most important thing to take away from the discussion of affordability versus qualification is that a borrower might be approved for a mortgage larger than which they can actually afford. The best advice in this area would have the borrower prepare a monthly budget representing all expenses associated with their lifestyle and include amounts for food, clothing, entertainment, and vehicle expenses, to name a few. Once all lifestyle expenses are deducted from the applicant's net take-home pay, the amount remaining could be considered a reasonable budget for housing expenses. In this next section, we will review some basic mortgage terminology. A mortgage is a legal document by which a borrower pledges property to a lender as security for a debt. When borrowing money by way of a mortgage, the borrower will have the option of determining which method of borrowing works best for their individual needs, subject to overall qualification. Let's review some of the basic definitions. A closed mortgage, a mortgage with a fixed contract length. This type of mortgage will allow for partial prepayments over and above the regular payments without penalty. However, to pay this type of mortgage in full before its duration is over will involve a penalty. A closed mortgage will have a duration from 6 months to 10 years in length. A closed mortgage may have a fixed or variable rate of interest. Open mortgage, a mortgage that allows a borrower to repay any or all of the outstanding balance at any time without any form of penalty. An open mortgage may have a rate of interest that either fluctuates during the term or is a fixed rate. The length of contract will range from 6 months, 1 year, 3 years, and 5 years in duration. Interest rates come in two varieties. Fixed rates. The interest rate is set for the duration of the term of the contract at an exact amount. Variable rates are also known as adjustable rates or floating rates. A formula is created, and each time the prime lending rate changes, the interest rate for the borrower's mortgage will change by the same amount. Two final definitions. Term. This refers to the length of your contract. Terms range from 6 months to 10 years. The shorter the term, the lower the interest rate. Amortization. This refers to the total period of time you have to pay off your mortgage. First-time homebuyers will typically start with an amortization of 25 years. Until a few years ago, amortization periods up to 40 years were available. However, these were recently discontinued as a result of the federal government tightening mortgage rules. The longer you amortize a mortgage, the lower your payments. But the longer you amortize your mortgage, the more total interest you pay your lender. Once you feel comfortable with your decision to go home buying and have a better idea of how much you can afford, the next step is to qualify for a pre-approved mortgage. A pre-approval is contingent upon the information you provide being verified by the lender. This is typically not done until the borrower has an accepted offer, and that offer will likely be subject to obtaining financing. This is referred to as a soft pre-approval. The disadvantage of a soft pre-approval is that the lender might interpret your documents differently than you have indicated on your application. A smaller amount of income might be used by the lender, and the mortgage amount you thought you were pre-approved for may end up being less than you need. The best alternative to this is to arrange a hard pre-approval. At the time you submit your application, a complete list of supporting documents are provided so there is mutual agreement on the amount you are approved to borrow. During the pre-approval process, a major decision has to be made by the borrower. This major decision will revolve around selecting the terms of the mortgage. Will you go with a short-term, lower interest rate product or a higher interest rate for a longer term? Will you select a mortgage product where the interest rate is set for the term or may increase or decrease during the term? This is a critical process, and a mortgage professional like me can assist you with a thorough review of the pros and cons of each option available to you and provide recommendations based on your individual abilities and risk tolerances. Once a pre-approval is arranged, the borrower can take advantage of the following benefits. It offers confidence and peace of mind when house hunting. It enables the borrower to search in a specific price range and protects the borrower for up to 120 days in the event that interest rates increase. It is vitally important to remember that a pre-approval is not a guarantee of financing. Even if you have provided all of your income and down payment documentation to your lender in advance of making an offer to purchase. Ultimately, the lender and high-ratio insurance provider, if your down payment is less than 20%, must approve of the property you are purchasing. Some properties might not be acceptable to the lender. It is important that you be aware of this when making an offer to purchase. A standard procedure is to make an offer subject to approval of a mortgage on specific terms. The following will outline the documents required to have your mortgage approved. While some lenders may not require these documents until you have an accepted offer, a wise practice is to review these documents with your mortgage broker or lender at the time of applying for a pre-approved mortgage. Documents for employment and income verification will consist of the following: a letter of employment, current pay stub, and your most recent T4 slip. For applicants that are self-employed, a lender may need to see your last 2 years of tax returns, notice of assessment, and company financial statements. To document your down payment, copies of your bank and or investment account statements covering the last 90-day period, a copy of a gift letter outlining funds that are being gifted from related parties. Your mortgage broker will compile all the necessary information and prepare a professional presentation to a lender on your behalf. One primary function of a mortgage broker is to locate funding for mortgage financing and to seek the best possible lender package to suit your specific situation and needs. Many homeowners, inexperienced in knowing what to look for in a mortgage, fail to see past the interest rate. Homeowners focused on just getting the lowest rate may fail to obtain a mortgage that is better suited for their needs with features and benefits that will ultimately provide for a lower long-term cost of financing. The majority of homeowners intend on paying off their mortgages as quickly as possible. Reducing the number of years until your mortgage has been paid off will reduce the total amount of interest paid to your lender and reduce the long-term cost of home ownership. All commercially available mortgages will have several different options available to pay your mortgage off faster. Each lender will have different options, and a professional mortgage broker can assist home buyers by not only negotiating excellent interest rates, but also ensuring that the right mortgage is chosen, thus allowing the borrower to take advantage of their ability to pay off the mortgage as soon as their cash flow allows. Here are a variety of techniques to pay your mortgage off faster than the initial amortization period. You can make accelerated biweekly payments, round up your payments to the next $50, double up your payments when available, and make annual lump sum payments on the balance of your mortgage. That pretty much wraps up our financing section. I have 2 additional resources available to you. One is a booklet entitled Home Buying Step by Step. It's a great consumer guide and also workbook. And for those of you that are looking at buying condominiums, whether they be an apartment style or a townhome style, we have the Condominium Buyer's Guide. To receive a complimentary copy of either or both of these booklets, feel free to give me a call at 604-818-2840. Although the process of buying a home can be overwhelming and daunting, the end goal of home ownership is well worth the effort and investment. I hope you found this section on financing both informative and easy to understand. With the right knowledge, I believe you will be better prepared to join the millions of homeowners in Canada in finding, financing, and eventually owning your home mortgage free. My personal philosophy is that there is no such thing as a stupid question when it comes to financing your home. Feel free to call or email me if you have any questions about financing your first home purchase. And with that said, it's time to look down the road on the way to achieving your goal of home ownership and envision that you have been pre-approved, found a home, have an accepted offer. Now comes the home inspection. Our next presenter is Glenn Duxbury, owner of Duxbury and Associates Building Inspection and Consulting. Glenn has been a home inspector since 2001 and has an extensive background in property management. Basically, he knows his way around homes and buildings. In his presentation, Glenn will be focusing on information that will come in handy when choosing an inspector and offer tips you can use when you're out looking at properties. Information that could help you avoid investing your precious time and money in a property that may not be suited to your needs. Please welcome Glenn Duxbury.
Thank you, John. I'm Glenn from Duxbury and Associates, Building Inspection and Consulting. This portion is all about educating you on getting the home you want and not buying a money pit or a leaky condo, plus choosing your inspector wisely. All right, in this first slide, you're seeing our first ebook, which was written for first-time buyers or anyone else who's never used this kind of a service before. How to choose your home inspector wisely. It's a free download off the website, so feel free to download and share it with family and friends. I'll also take the opportunity to mention that we have been in business for 18 years and we have that much experience for your protection and education here at Duxbury and Associates. How do you find a great inspector? Check online reviews. Ask others who have bought properties in the past. There's really no need to reinvent the wheel. Good realtors will refer 3 good home inspectors, usually. Again, going back to that last slide, read our free ebook. Once again, it's a free download off the website. And make sure you ask lots of questions. You might wonder why I'm emphasizing asking lots of questions. Well, it's important to know that this is a service, a professional service, and not just a commodity. So by asking before you hire, you're going to be able to choose better and get a better outcome. But let's talk about you now. Make sure you are welcome to attend the process, attend the inspection, and ask lots of questions. In our experience, first-time buyers especially have a lot of questions. And I love educating our clients. It's a good thing for you because you get way more than just a report handed to you at the end of the day. You've got a good education. You will then know the home better than the current owner does. And that's saying something. Here's some information about our professional association. ASTT BC members are not just licensed, but are also bound by a code of ethics and are accountable to a board of discipline in case of a complaint. A good and experienced inspector, as just mentioned, will help educate you too. How things work, what your priorities are, how to maintain the home, what you can and cannot do if it's a strata property, and save you lots of money in the end. Here's what a home inspection is not. It's not a warranty, it's not a guarantee, it's not really a look into the future either. And, as importantly, inspectors do not have X-ray vision. So the process will be limited to what is visual and visible. How long should the process take? In our case, 4 to 5 hours for a house. Anything less would be from 2 to 3 hours for a condominium, or 3 to 4 hours for a townhome. First impressions. This home looks okay from the street, but a close-up look by us for this homeowner has revealed a lot of deficiencies. It was really put together poorly and finished poorly.
Now that you have found your first home, made your offer with the assistance of a realtor, secured the financing with a mortgage lender like me, and removed your subject condition following a successful home inspection, it's time to turn over the process to the legal professionals that will make sure your real estate transaction closes properly. Our next presenter is Sean Hogan. Sean is a partner in the full-service law firm Buckley & Hogan, where they specialize in real estate, company and business law, litigation, as well as wills and estates. Sean has over 2 decades of experience helping homeowners through the closing process, and he joins us now to take a look through the legal process and demystify the final stages before you get your keys and move into your new home. Over to you, Sean.
Thanks, John. I'm going to review some of the legal aspects of buying a home. We'll review the contract, the types of ownership, terms and conditions, as well as the costs of buying and owning property, and the process of signing your purchase documents and getting the keys to your new home. The first thing we're going to talk about in buying a home is the contract. Your realtor will work with you to prepare the contract of purchase and sale. It'll look like this form. You complete this form to make an offer to the seller. The seller may accept, reject, or make a counteroffer. Changes are usually made by hand and initialed. When you and the seller have reached an agreement, the seller also signs a contract, and you have a deal. Let's look at some of the parts of the contract. I won't be discussing the price or the amount of the deposit, those are things that you will negotiate with the help of your realtor. There are 2 ways to own property where there are more than one owner. Most couples will own property as joint tenants, which means that they own equal shares, and if one person passes away, the ownership automatically passes to the survivor on filing a death certificate. The other way to own is called tenants in common, where the owner can have different percentages of ownership. It could be 50-50 or 75-25 or something else. If one owner dies, his or her share does not go to the survivor, but goes to the beneficiary of the deceased person's estate. Either form of ownership can apply to 2, 3, or more owners and can be used in combination. For example, 2 couples can own property as tenants in common, with each couple holding their share as joint tenants. One of the first things you need to consider is who will be the buyer of the property. With the changes in 2016 to prevent assignments or flipping of the contracts, contracts now include a term saying that you cannot change the buyer without consent of the seller, which the seller does not have to give. So if you only put your name as the buyer and later want to add your partner, you may not be able to do so. This can be important if you need to have the other person on title to qualify for mortgage financing. In paragraph 3 of the contract, you can add subject conditions. These are conditions that you need to satisfy before you will commit to purchase the property. Common subjects are financing. Even if you have been pre-approved for a mortgage, your lender will want to view and appraise the property to confirm that it's worth the price you are agreeing to pay. You'll want the buyer to agree to give access to the lender's appraisal. Consider hiring a home inspector to go through the home and look for any actual or potential problems. Your realtor may be able to recommend someone, or you can find one online. Your realtor can provide you with a copy of the title to the property. It's common to find things registered against title, such as covenants, easements, and rights of way. A covenant, or permit as it's sometimes called, is a city's way of controlling the construction or use of the property. An easement is a right of use or access, such as allowing water to flow downhill or sharing a driveway. A right-of-way allows something to be placed in the property, such as a storm drain or a sewer line. You should review and understand all of these. If you plan on building, renovating, or changing the use of the property, you should check with City Hall. Most cities also have free online mapping, which provide a lot of information about the property that you want to buy. Sellers are required to complete a form called a Property Condition Disclosure Statement, which gives you information about the property, including whether there are any known problems. Review this carefully and ask questions if you have any. When you buy a property, the purchase includes everything that's attached. That includes such things as wall-to-wall carpeting, cupboards, and counters, but it does not automatically include things that are not attached. For that reason, it's common to specifically mention and include appliances, blinds, and window coverings. If there's something in the property that you want, such as mirrors or pictures, which are only held on by clips, then list it as being included. Similarly, the seller may want to list some attachments as excluded. The contract includes a term saying that the contents of the contract are the entire agreement. When you review any contract, you should consider both what it says and what's missing. If it isn't in writing, then it isn't part of the deal. So if there are any terms that are important to you, make sure that they are written into the contract. Next, we're going to talk about costs of buying. In determining your down payment, you also need to consider other costs of buying a home. When you sign the contract, you agree to be responsible for any taxes. The property transfer tax is a tax from the government of BC and is equal to 1% of the first $200,000 and 2% of anything above that. There are additional taxes of 3% if the price is over $2 million and 15% for non-resident foreign buyers. So if, for example, your purchase price is $500,000, your property transfer tax will be $8,000. There are some circumstances where a buyer is exempt from paying property transfer tax. One of the most common is for first-time buyers. To qualify, you must be a Canadian citizen or permanent resident, have lived in BC for at least 1 year, or filed taxes as a BC resident in 2 of the last 6 years, and not own land anywhere in the world that you used as your home or principal residence. You also have to move into the property after buying it and live there for 1 year. The full exemption only applies to property under $500,000, with a partial exemption up to $525,000. If the property is more than $525,000, there's no exemption even if you meet all of the other qualifications. The Government of Canada also charges GST of 5% on newly built homes. Substantially renovated, that is practically new homes, commercial, and recreational property. If you're buying a used residential home, there is no GST. If you're buying a new home worth less than $350,000, you can get a rebate of 36% of the GST to a maximum of $6,300. There's a partial rebate for homes worth up to $450,000, but no rebate for houses worth more than $450,000. You don't have to be a first-time buyer to qualify, but you do have to move into the home and live there for a year. Cities charge an annual property tax, which is due at the beginning of July each year. Although the tax is paid halfway through the year, it's for the calendar year. So if you're buying a home in the first half of the year, the seller will give you a credit towards the seller's share of the taxes, but then you will have to pay the full tax on July 2nd. If you buy in the second half of the year, you'll be reimbursing the seller for part of the taxes that the seller paid in July. Cities also charge for utilities such as garbage, water, and sewer. If you're on a metered water supply, you'll pay those around every 3 months. If you're not on a water meter, you'll pay those on March 31st each year. Depending on whether there's a water meter and the timing of the bill, there will either be a credit or a debit on your purchase for the city utilities. Lawyers and notaries are very competitive in terms of fees that they charge. In addition to the fees, there are a number of expenses such as land title office charges, searches, taxes, agent fees, and insurance binders. Those fees and costs can range between $1,000 and $1,500 total. Many banks and trust companies which deal with properties across Canada also charge title insurance, which protects them in the event of a problem with the ownership. That fee depends on the value of the property and will be at least a couple of $100s. Credit unions, which only deal with properties in BC, do not usually require title insurance. If you're buying a strata property, such as a condo or townhouse, there will be fees to be paid to the strata which may be up to $200. The seller is required to provide additional information to purchasers of strata property. These typically include 2 years of the minutes of the strata council meetings, bylaws, and financial statements. Read them to look for past problems, previous repairs, special assessments, and any expected upcoming expenses. The contract will often include a term saying that if the strata declares any special assessments before you buy, the seller is responsible to pay. Make sure this term is included, but be aware that if an annual or general strata meeting is held after you buy, and the strata requires owners to pay a lump sum for special expenses, you will be fully responsible for your share. As of 2013, stratas with 5 or more units are required to obtain a depreciation report, which projects anticipated repairs, maintenance, and replacement over a 30-year period, as well as a financial forecasting of expenses. A 3/4 majority of owners can vote to exempt ordering that report. If the strata you want to buy has a depreciation report, review it carefully. If it doesn't, then you'll be relying on your review of the minutes and the report of the home inspector. Stratas operate by way of majority votes. That can work well in many cases, but in others it means a majority can create problems for other owners. You may want to talk to members of the Strata Council, other owners, and the property manager to find out if there are any internal conflicts or control issues which might negatively impact your use and enjoyment of your new home. Once you've the money to buy your home, you're going to need money for the cost of owning it. Make sure you budget for these ongoing expenses. These include monthly expenses such as hydro, phone, and internet. You also may be required to pay setup fees to start those services. There are also annual expenses such as the city property taxes, the city utilities, and insurance. You may want to make arrangements with your lender or the city to make monthly payments toward your taxes or utilities to avoid having one large bill each year. You may also have moving costs and the costs of buying furniture or appliances. When I bought my first home, we had to put aside money for repairs and maintenance. We had used appliances that broke down almost every 2 months. First the washer went, then the dryer, and then the hot water tank. Fortunately, we would just finish paying for one, so we had saved money to pay for when the next one broke down. We also made a list of upgrades that we wanted to do, starting with the bathroom. So budget for the unexpected as well as for any upgrades that you want to do to make the home your own. A fixer-upper can be very cost-effective if you're in the trades or have friends who have those skills. But be careful of buying a home that may need more work than you have either time or money to spend. Next, we're going to discuss what happens when you finally get to buy your home. When choosing any professional, it's always best to find someone who's recommended to you. Your realtor, family, or friends may be able to recommend a lawyer or a notary. Both are competitive in terms of fees for home buying, and you always want to have someone with experience. The main difference between a notary and a lawyer is that if a legal problem develops, the notary will not be able to assist you and will have to refer you to a lawyer. That said, there are very experienced notaries, as well as very experienced lawyers, who do real estate deals. Once you've removed subject conditions and the deal is binding, your realtor will send a deal sheet to your lawyer or notary with some information about the purchase and a copy of the contract. Your lender will likewise send mortgage instructions. Lawyers and notaries all use conveyancers who are specialized real estate secretaries. The conveyancer will contact you to get all necessary information and to make your appointment. The appointment is usually a few days before the completion date. You'll meet the lawyer or the notary to review and sign all of the purchase and mortgage documents and be able to ask any questions they may have. You don't have to meet with the lawyer or notary on the actual completion date. The transfer and the mortgage are registered at the land title office, and funds are made available for the seller's lawyer or notary to pick up. The seller usually gets their funds on the next business day after the completion date. For that reason, it's usually better to have a completion date on a Thursday or earlier in the week, so that on Thursday you become the owner, on Friday the seller gets their money, and on Saturday you move. You'll meet with your realtor on the possession date, who will provide you with a set of keys to your new home. The seller usually leaves the additional keys inside the home for you. You'll get 2 reports from your lawyer or notary after the purchase. The first is a copy of the registered transfer confirming that you're the owner, and you'll receive that in about a week. The second is a copy of the title, which may be a few months later, to ensure that the seller's old mortgage has been discharged or removed from title. Congratulations and enjoy your new home. Let's turn it back to John as we continue with our first-time home buyer webinar.
Thanks, Sean. Ladies and gentlemen, there you have it, your first-time home buyer webinar. As you can imagine, there's a lot more information you're going to need to make an informed decision about buying your first home. Speaking on behalf of our presenters, we welcome your additional questions by email, and we will do our best to get back to you with the additional information you're going to need to make your first home purchase an easy process and an excellent investment. Best of luck in your home search, and don't forget to send us an invitation to your housewarming party. We'd like to join you and celebrate your first home purchase.